Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to this 2025 Taxes Schedule E working session, where we are going to work through all of the basics of entering both domestic and foreign rental property into TurboTax. Okay, so we're over here in the TurboTax Home and Business Edition 2025. We're going to be on the Business tab right here, Business Income and Expenses, and then specifically right down here in Rental Properties and Royalties. So I'm going to hit Start right here, and let's get into it. Okay, item number 1, do you have any rental or royalty income and expenses for 2025 for property that you own? We're going to say yes to that. Okay, next item, let's see if you are a real estate professional. Now, why does this matter at all? And the answer has to do with deducting losses from a real estate activity. If you are considered a real estate professional, then you are considered to be in the business of renting property or otherwise engaging in real estate transactions as a trade or business. In the context of what we're talking about right here, the opposite of a trade or business would be a passive activity. For folks who are not in the business of engaging in real estate transactions or in the business of renting property, generally a rental is considered a passive activity. And we will get to more questions coming up with respect to the passive activity loss rules. But again, all of this has to do with deducting losses from real estate. If you have income, then none of this really matters. Income is income, whether you are a real estate professional or otherwise. It's really dealing with losses where all of the special rules come into play. So let's run through this real quick. Real estate professionals may pay less in taxes since their rentals are considered a business. We'll determine if this applies to you. Check the items that apply to you or your spouse in 2025. I spent more than 750 hours a year actively involved in real estate, either sales, management, renting property, etc., and I have complete records for my time. I spent more than 50% of my work-related time involved in real estate, or none of the above. For most people who have a handful of rental properties, even if you are the one dealing with maintenance issues or finding tenants, collecting rent, and so forth, more than likely you do not meet either of these two requirements. Generally speaking, this is a pretty easy test to figure out. You are either in the business of dealing with real estate or you are not. And for most people, the answer is you are not, so we're going to click none of the above and click continue. Okay, next item, is this a rental property or a royalty? A rental property is real estate that's leased or rented out to others. For this example, we are going to do a rental property, not a royalty item. We're going to call this the North Street Rental. We're going to say it's a domestic property located in the United States. Here is the address we're going to use, and this tax return has a married filing joint couple in it. We are going to say that this property is jointly owned by both of them. Continue. All right, next item, what type of rental is this? Now, in my tax season 2026 prep and planning class, which is going on right now between February the 1st and April the 15th, 2026, we can cover any of these choices down here if they are applicable to you and you are in the class: multifamily, vacation, commercial, land, self-rental. But for purposes of this video, we're just going to select single-family home, which is going to be one of the most common choices, and then we'll hit continue right here. Okay, do any of these situations apply to this property? Is it new to the current year? Was it sold in the current year? Did you rent out part of your own home? Was the rental unit one unit in a multi-unit property? Did you convert from personal use to rental use or vice versa? Do you have passive activity losses or at-risk losses carrying over from another year? Again, these are all great scenarios down here which we can cover in the tax season 2026 prep and planning class for anybody to whom these are applicable. For purposes of this video, let's select this option right here. It's a new rental property for 2025. Okay, was this property rented for all of 2025? Let's assume for this example that the answer is no. Maybe you did not even purchase purchase the property till sometime after January 1st, 2025, and therefore it was not rented for the entire year. We'll select no on that question. All right, so let's set up a rental property information tab here in our work papers. We're going to say that the North Street rental was placed in service on July 1st, 2025. Placed in service means you started to rent it out. So we're going to have rental days that go from July the 1st through December the 31st, 2025. That's a grand total of 184 rental days, and then we're going to say we have 0 personal use days. So I'm going to drop 184 days right here for the rental days, 0 for the personal use days. Continue. Property ownership. Were Bill and Sarah the only owners of this property in 2025? Now, just to be clear, this is not talking about the previous owners from whom Bill and Sarah purchased this property in order to turn it into a rental. What they're talking about here is during the time that you rented the property, did you own 100% of the property, as opposed to owning it in conjunction with somebody else, like in a partnership or with multiple partners. If you owned this property with multiple partners, then we would be required to allocate income and expenses between various people or parties. For this example, we're just going to assume that is not the case, so we will say that yes, Bill and Sarah owned 100% of the North Street property. Continue. Okay, let's find out if you're an active participant in this property. The term active participant refers to a special category of rental property owners. Active participants in a rental property may qualify for additional write-offs if they have a loss on the property. So once again, this is all about losses. Just like when we were talking about being a real estate professional, that was all about losses. You can think of it like this. If you're a real estate professional, you would be able to deduct the most losses. If you are not a real estate professional, but you are an active participant, which we will get to the criteria for that in just a moment, you can deduct some losses. And if you don't meet the requirements to be an active participant, basically you only have passive losses, which you can't deduct unless you have other passive income against which to deduct it. The key to the active participant is that some amount of losses, even though they are still considered to be passive losses, under this rule you are allowed to deduct those passive losses against ordinary income, which could be like income from a W-2 or a business, for example. That's what all these rules are trying to prevent. They're trying to prevent you from deducting too much passive loss against other kinds of income. So right here, you qualify as an active participant if you can answer yes to both of these two statements here. I own at least 10% of the property. We already said yes to that. They own 100% of the property in this case. I make major management decisions for this property, such as approving tenants and authorizing repairs. Right here, let's talk about the Number Crunch Nerds broken toilet test. This is not an official IRS test, but it's a nice, simple way to make an easy determination if you are an active participant. The broken toilet test is if the toilet in the rental property breaks in the middle of the night, who is going to get the call? Are you going to get the call, and will you need to deal with getting a repair person out there, or perhaps you go out there yourself and fix it? Or is someone else going to get the call, for example, a property management company? If you are going to get the call for the broken toilet in the middle of the night, I feel pretty confident that you can say yes, you are an active participant in the property. However, if you've outsourced that responsibility to some sort of manager or property management company, it is likely much more difficult for you to argue that you are actively participating in the property. If a management company is basically doing everything, including finding the tenants, dealing with repairs, collecting the rent, and all you do is just collect the difference between the rent and any expenses from the management company each month, you are most likely not an active participant in the property. However, for this example, let's assume there is no management company involved and that this family does actively participate in this rental, so we're going to click yes right here, continue. Okay, did you pay anyone $600 or more for work related to this property? This is a question about your personal responsibility to file a form called the 1099 NEC, which is reporting payments that you made to an independent contractor that provided services to your rental property during 2025. Now, there are two big outs to this question. Big out number one is that if the person or business that provided services to your rental property is a corporation, meaning they have the word INC at the end of their business name, You don't have to file a 1099 NEC for payments to an incorporated entity. So that's the first big out on this requirement. Big out number 2 on this requirement is if you made these payments, regardless of amount, by credit card or third-party payment processor. If you made the payment by credit card or third-party processor like PayPal, for example, then you do not have any filing requirement with respect to the 1099 NEC regardless of the amount paid. Also keep in mind, just so there's no confusion, this is only for payments you made with respect to businesses that you are running, and in this case, a rental property is considered a business for this purpose. In other words, this is not for personal stuff. Like if you pay someone to come out and fix your personal residence, then there's no filing requirement at all. This only has to do with businesses where you're generating income, like a Schedule C business, which is not what we're talking about right now, or a Schedule E rental property, which is what we're talking about in this video. So basically, in summary, if you paid an individual or a company that was not an incorporated entity and you paid them by check and it was more than $600 in total for 2025, you would click yes right here. Let's just assume the answer is yes for this example. And the second question is just going to be, did you actually file the 1099s, which would be due by January the 31st of the subsequent year, January the 31st of 2026 in this case? And we're going to say yes, that we filed those 1099s. If those situations do not apply to you, just go ahead and select no right here. Let's click continue. Okay, let us enter your rental property info for you. So if you track all this in Quicken or QuickBooks or in one of these file formats right here, you can certainly go ahead and do the import. For today's video, we're just going to enter the information ourselves. So I will click continue right here. Let's see now a couple more questions. Is your property in any of these designated areas? These situations are not common but may give you additional deductions. Qualified disaster areas, Indian Reservation property, Kansas Disaster Zone property, and Gulf Opportunity Zone property. If you have any of these special situations, happy to go over those details inside the 2026 Prep and Planning class. For this example, we're just going to check none of the above. Continue. Okay, tell us about this property. Now let's use the rental property expert tools to calculate depreciation and maximize your rental expense deduction. First, we're going to ask you about all these basics. So let's come up with some fact patterns, which we will add to our work paper over here. Okay, so for this example, we will say the date of purchase of this property was April the 5th, 2025, $542,000 purchase price. We put in $25,000 of improvements to get it ready for rental, and we took out a mortgage on the property of $300,000. And then the one question left on this page, was this property your residence in the past? For this example, we're going to say no to that. Continue. Okay, how did you acquire the property? Let's go through the options right here. I bought this rental, which is going to be the most common one. That's what we're going to use for this example. I acquired this rental through a like-kind exchange. This right here is known as a 1031 exchange. We are going to do a module on this in the 2026 Tax Prep and Planning class. So if you're interested in learning about 1031 exchange, we're definitely going to cover that. I inherited this rental. That's relatively common. I received this rental as a gift, not quite as common, or none of the above. As I said, for this example, let's go with the most common scenario. I bought this rental. Continue. Okay, gather property value information. We're going to need the current property tax bill, mortgage paperwork, purchase paperwork, and receipts for improvements and expenses. Let's just start with this information that we have right here, and as questions come up over the subsequent screens, we will add some facts and details here to build out the example. Continue. Okay, enter the purchase price. The purchase price is the original price you paid for the property, and it helps us determine your depreciation deduction. Also enter the date the rental property was ready and available to be rented out, as well as your original purchase date. Okay, so original purchase price, including the land, we're going to say that that is the $542,000 that we added to our fact pattern over here. The available date, let's go ahead and say that that was 15 days-ish before it actually started to be rented out. So we'll say that this is June 15th, 2025. Okay, purchase date, April the 5th, 2025. We did have that over here. I did add the unit was available on June 15th, 2025. Continue. Okay, enter escrow fees. Fill in the following fees you paid when you bought the property. You can find this information on the settlement papers sent by your lender or escrow company. All right, so the document that you're looking for is the one that typically has like 2 columns side by side, one for the seller, one for for the buyer, and it reconciles all of the different purchase price, sales price, all of these different fees, if there were property taxes that were covered by the seller or the buyer, other fees and so forth. Let's just go ahead and add these items down here to our fact pattern, and then I'm going to go ahead and drop these into the relevant boxes right here. Continue. Any seller paid points on the property. Let's just assume 0 for this example. I'm going to click continue. Any property improvements made. Enter the costs of any additions or improvements made prior to when the property was available for rent. We already said down here in our fact pattern that our cost of improvements was going to be $25,000 for this example. Let's just assume that all goes with remodeling. No room additions, no special tax assessments for this example. Continue. Okay, any other payments? We're going to assume that none of these apply for this example, but certainly if you have easement payments, energy credits, energy subsidies, the amounts can go in here. We're going to say 0 on that. Continue. Any other adjustments, either increases or decreases? Let's see what some of the provided options are. Legal fees paid to defend the title of the property. That would be like added to the cost of the basis you have in the property. Legal fees to challenge an assessment, the cost of extending utility service lines. We're just going to say no on all of these various items. If you have any of these unusual items, we can certainly add the amounts in right there. Continue. Okay, enter property tax values. Now let me just pause real quick and point out one thing. You may have noticed that the amount of federal refund showing right here has changed from the previous screen. And the reason for that has nothing to do with the rental property example that we are working on. When I first started recording this example, it turned out that the depreciation module within TurboTax for 2025 actually was not yet available. Intuit was still in the process of updating the software for 2025. So because of that, there was a pause for a few days between everything recorded in this video that you have watched so far and everything that you are going to watch from this point forward. And during that several day hiatus, I did some other examples for the 2026 tax prep and planning class. And it was those other examples on other tax topics that caused this federal refund to change. For purposes of the rental property example that we're working on right now, everything is the same. We are going to pick up right here where we left off a few days ago. And we're going to continue on this screen right here, enter the property tax values. Okay, so let's take a look at what it says here. Use the values listed on your property tax bill to find this information. Now, instead of digging through all of this reading right here, let's just talk about high level what this screen is asking for and what the point of the information is. When you purchase any piece of business property or rental property or any property that is subject to depreciation, you're going to have to make an assessment of the amount of value that is allocated to the building and improvements to the building and perhaps improvements to the surrounding land, and then conversely to the land itself. Because the building itself and improvements to the building and improvements to the land, like for example paving a driveway or putting down a sidewalk or building a fence, all of those items are depreciable, meaning you can calculate depreciation on them and you can deduct a certain amount of depreciation on your tax return every year. However, the land itself is not subject to depreciation. Land is not a depreciable asset. And so what they're telling you to do right here is to use any reasonable method to figure out how much of the total purchase price should be allocated to the building and other improvements versus the land. One possible location where you might find that information is the property tax bill, assuming that the property tax bill actually shows a breakout between the building itself and the land. Another possibility, if you don't have a property tax bill or if the property tax bill doesn't show the breakout, is to use values listed on your insurance records. But again, that would require the insurance records to show some sort of value breakout between the land and everything else. If you don't have that information in any of these places, then industry practice is going to be to allocate 20% of the purchase price to the land. Now that 20% number is not an IRS rule. It is simply something that is commonly done in the tax profession if there is no better information upon which to make an assessment as to the value of the building itself versus the land. So for this example, we're going to use the 80-20 breakout. I'm going to go right here to our work paper. I'm going to insert 2 rows right here. And then what I'm going to do is take this total purchase price and I'm going to multiply it by 80% and call that the allocation to the building. and then I'm going to multiply it by 20% and call that the allocation to the land. Again, there is no hard and fast rule about exactly how this allocation has to occur. It just has to be something that a reasonable person would consider to be appropriate and either based on a property tax bill or insurance records, or just an 80-20 allocation if you have no better information than that. And so now what we're going to do with that information is I'm going to put the land value right here, 108,400, and then I'm going to put the value of everything else, 433,600 right here. And so what's going to happen is that this 108,400 will not be recovered through depreciation. This 108,400 can only be recovered when you actually dispose of or sell the property at some future point in time. This 433,600 is what will be recovered through depreciation on an annual basis related to this rental property. And in addition to that, what TurboTax is going to do is it will take the allocation right here, which we know to be 20% here, 80% here, but it could be whatever percentages are calculated off these numbers. For example, if they came off of a property tax bill or your insurance records, and they weren't exactly 20% there and 80% there, whatever the percentages are, TurboTax is going to apply those percentages to all of these other costs right here under the basic approach that all of these have some relevance to both the land and the building. And therefore, some of it should be allocated to the land and some of it should be allocated to the building. And as you might imagine, the portions that are allocated to the building will be recovered through depreciation, and the portion that is allocated to the land will not. So before we continue, let's go ahead and figure out how much of all of this we think is going to be subject to depreciation. And then we will check TurboTax to make sure that what we think the calculation should be is what TurboTax has also determined. All right, so what I'm going to do here is just insert one more row, and then right here, I'm going to put a few captions. All right, so we have the total items in this column, and then we're going to have the portion that goes to the building and the portion that goes to the land. So the first thing is we already know that that part is allocated to the building, and we already know that this part is allocated to the land. In addition, we already know for this example that it's 80-20, but it may not necessarily be 80-20 in all cases. So I think what we're going to do is right here above building, we're going to go ahead and put equals. We're going to take this item and we're going to divide it by the sum of both of these items right here. And we know that's going to be 80%, but as I said, it may not always be 80% in all cases. I'm going to go ahead and copy a very similar formula over here with the allocation to the land being the numerator. I'm going to go ahead and make these into a percentage like that. And then what we're going to do is we're going to go down here and I'm going to say equals, I'm going to grab this number, I'm going to multiply this by the 80%. I'm going to hit my F4 key to lock it on this cell. I'm going to hit enter, and we're going to allocate 80% of each of these to the building. And then let's go ahead and drag that over one. Let's double click on it. Let's move this over to the 20%. Let's move this over to the 400, hit enter, and we're going to allocate 20% of all of those items to the land. Now, another thing that I think the system will do, which I'm not sure that I really like that it's going to do this, and we're going to talk about in more detail. I think if I copy that and I paste it right here, I believe it's probably going to allocate the cost of the improvements on a percentage basis based on our land versus our building breakout like this. So it's going to put 80% of that here, 20% here. Now, I'm not sure that I agree with that or like that, because if you think about it, assume that these improvements, you know exactly what they are. Let's say they're all improvements to the building itself or the interior of the building. None of them are improvements to the land. And even if they were improvements to the land, like putting up a fence or paving a driveway or something like that, that's still a depreciable item. Now, I don't think in that case that part of the cost of these identifiable improvements that you made to get the home ready for rental, I don't think that a portion of that should be allocated to non-depreciable land, because we can specifically identify those costs and say these items have nothing to do with the initial purchase price. These were costs of improvements that we made after we initially purchased it. We know what they're for, but now we're allocating, based on this method, $5,000 in this example to non-depreciable land, and so that $5,000 will be hung up in land for the entire time that we own this property and won't be able to be recovered until the property is sold. So assuming that TurboTax does handle it the way that I'm describing right now, which we will double check in just a minute, there is a way we could get around that by putting the cost of improvements in later as another asset, not wrapping it up in the purchase of the property itself, which is what we are kind of doing right now. All of these, because they're part of the purchase document, part of the purchase process, these costs are appropriately allocable to the purchase, and therefore I would agree that they are allocable to both the building and the land, and so whatever the percentage breakout is, that's fine. I agree that that's appropriate, that they are allocated that way. But for these, I would argue if we feel like it's inappropriate, these should be entered as a separate asset, fully subject to depreciation, all $25,000, and not allow $5,000 to get wrapped up in the land. Okay, so let's just see if TurboTax is doing it the way that I described. Let me update the formatting right there. Let's go ahead and sum all of this up before we continue. I'm going to go down right here and I'm going to do a summation. Let's just go ahead and grab everything above right there. And then I'm going to grab all of these and let's go ahead and see if that is the amount that TurboTax is saying should be subject to depreciation, $458,480, and then the amount that should not be subject to depreciation because it's all allocable to land, $114,620. So I'm going to go ahead and click continue here, and let's see if that's the case. All right, depreciation results. Your rental property at this address will be depreciated by $458,480. So there's the $458,480 right there during the next 27.5 years. This is just the tax law applicable to residential rental property, okay? This is not something specific to this example. This is the tax rule. 27.5 years is the length of time that you depreciate residential rental property, okay? So it looks like TurboTax is doing what I said. It is allocating the cost of these improvements, a portion of it to the building, a portion of it to land. I would argue we could probably be more aggressive on that, remove this from this initial purchase section and enter it as a separate asset if we wanted to, getting all $25,000 subject to depreciation, okay? This is how TurboTax is calculating it, which we can see right here, which would mean when I go to the depreciation schedule, I think it's pretty reasonable we would expect this number to be allocated to land. In fact, let's go check that right now. I'm going to hit continue right here just to make sure everything is up to date. There's our assets and depreciation section, but let's go to the forms view instead. And then let's go to the depreciation schedule, which is going to be right here. Depreciation report, page 1. Let's make sure that our breakout is as we expect it to be. So right here, let's see if I can make this a little bit bigger. There is our residential property. There's the date placed in service, 6/15/2025. There's the cost net of land, $458,480, and then there is the amount allocated to the land, $114,620. Okay, so the depreciable basis is $458,480. That's the number we calculated right here. The total amount subject to depreciation. It is subject to depreciation over the 27.5 years. That's just the tax law applicable to residential rental property. The method by which it is depreciated is straight line and the mid-month method, okay? So let's see if we can understand what that means. All right, so going down here, this is the depreciable basis as we said. So what I want to do first is I'm going to take 27.5 right here, and I'm going to divide this 458,480 by 27.5 years. So what is this result right here? 16,672. What does that mean? It basically is on a straight line method. Straight line means just take the total amount that is subject to depreciation and divide it by whatever the rule says you have to depreciate it by, in this case 27.5 years. This would be the amount depreciated per year, except for this half year that's kind of like stuck in there. That is an annual depreciation number. Now, let's take it a step further. Let's go ahead and divide this number right here by 12. And so this would be what? That would be a monthly amount right there. Let's make all the formatting on this the same. So this is a monthly depreciation number right there. Now, how many months have we depreciated the property for in this case? So it was placed in service in June. Now, usually, whenever you place it in service, it counts for the entire month, except in the first month where it's the mid-month convention, which means it only counts half the month. Now, we happen to have put it in service on exactly like the halfway mark, but if it had been put in service like on June 1st or on June 30th, it doesn't really matter. It would still count half the month. It has a mid-month convention is what it's called. So basically, we have June, July, August, September, October, November, and December. 7 months, but really the first month is only half of the month. So it's 6.5 months. I'm going to go ahead and put that decimal in there so we can see that it's 6.5. So 6.5 months, that's a monthly depreciation number. And I'm going to multiply that monthly depreciation number by the number of months, including the mid-month adjustment, which is the convention applicable to residential real property. And $9,031 is the amount of current year deduction or depreciation that you get in this particular fact pattern. Okay, I put in the titles that we just went through just so it's clear when folks download this work paper in the prep and planning class. So depreciable basis is this. Again, this only applies to building. This does not apply to land right here. That is the depreciation rate. That's the tax law for that. Annual depreciation, monthly depreciation, the number of months relevant to this situation plus counting the mid-month convention equals 2025 depreciation, $9,031. That's how you can understand what is happening here and why you get this amount of depreciation in that situation. All right, so coming back here to the step-by-step view, so far we have entered all the information in the property profile in the 2026 tax prep and planning class. We're going to continue this example. We're going to do the rental income. We're going to do the expenses. We're going to enter another property that's foreign instead of a US-based property so that we can deal with foreign rental issues. We're also going to enter any vehicle expenses that are relevant to the management or maintenance of the rental property. And we will check out Schedule E in the forms view to look at the complete result for all of our rental properties and how it flows to the face of the 1040. If you are not yet a member of the 2026 tax prep and planning class and would like to join, you can find a link to join the class in the description below this video on YouTube.